Paul Parker is the chairman and global head of M&A at Barclays Capital. And just last week, his team advised on 5 transactions valued at over $20 billion, including the Exelon Constellation Energy merger. He's here with us on InBusiness to talk about what's ahead for the market. How many more weeks are you going to have like that?
We hope to have the rest of the year like this and beyond. Thanks for having us.
Thanks for coming on. But I mean, I say that with a bit of humor, but truly, there is question about whether this momentum can continue. How do you characterize where we are in the M&A market right now?
Well, you're at the beginning of a cycle that has a good year behind it and probably has 5 to 6 years to go. And that's what we see when you look back over time. You have a 2-year trough, and then you have a 5 to 7 year run rate coming out of that.
Now, part of what seems to be the trigger for this is just the availability of cash at some companies, right? We've been talking about the $2 trillion that the Fed says is on corporate balance sheets. Is there really a push to get deals done in the immediate sense? I mean, why deploy that cash now? Okay,
well, there are really 2 big drivers, structural and fundamental. And structurally, you're right, cash on the balance sheet is absolutely dilutive. It's not earning anything given where interest rates are. And as it continues to build up, you either need to use it or give it back. Investors are saying you can't let it sit there and lie fallow. So either use that. And the same thing for interest rates. If you're going to borrow money to make an acquisition, I'll give you an example. In February '09, we looked at a $50 billion transaction for a company, and the interest rates, and it was a high-grade transaction, would have been 8.5%. Last year, same period, would have been 5.5%. This February, 4.4%. So on a $50 billion transaction, that's a $2 billion pre-tax savings, or basically $1 billion plus of cash flow. That is a pure synergy just where interest rates are. So if you have a strategic imperative and you're going to borrow or you're going to use your cash, which is, again, is dilutive on your balance sheet, why would you wait? And I think that's what a lot of people are thinking about right now.
I'm not going to pay a dividend. I might as well use that cash in some way.
And again, given the amount of cash that we're talking about, you can pay a dividend and still make organic acquisitions and continue to grow your business.
Yeah, when you were talking about the interest rate equation there, I talked to people in like the private placement business recently, and they're saying, you know, companies that do need to raise money or talk about issuing debt, that there is a push to get things done quickly because there is apprehension of what happens after quantitative easing ends in June. Do you see that push to get things done?
It's less explicit, but I think people believe, is it going to get better than it is right now? It doesn't seem possible. And as the federal government has to roll over 45% of its debt, that's the elephant through a keyhole. There's a lot of pressure that's going to be on interest rates. It won't be 100 to 200 basis points, but it's still going to be an upward push. Why would you wait if you had that opportunity to move now?
So do you expect June to then, you know, we'll see a steady push through there, but that's not going to be the peak? You think it'll continue post?
M&A is a lumpy business, and so, you know, it will go a little bit in fits and starts, but the trend is going to be gradually upward because I mentioned structural reasons, and so, again, cash, interest rates, and where, you know, values are. Values are still relatively low on a historic basis, and where we believe earnings are going to go. Then you've got the fundamental drivers, and that's the economy. M&A will follow the economy.
Well, what are the disruptors to that? I mean, we start hearing rumblings about changes in corporate tax policy, that sort of thing, things that might make companies worry about the cash that they have.
There's so much built up at this point, and the rates are so low, it's so dilutive. I think you're going to get much more pressure again from activists telling you to give it back, and frankly, your long-term shareholders saying, use it productively or return it. I don't see that those kinds of pressures are going to keep people from doing productive M&A transactions.
Is the emphasis going to be in those, you know, companies that are experiencing a cash boom in other ways right now, i.e. energy? Is that going to be the concentration point?
Well, the largest sectors in the market are financial institutions, energy, natural resources, and of course industrials. And then the other sectors are all, it's fairly well balanced, but those are the biggest 3.
Sure. And Paul, it's kind of a perfect segue to you to look at what's happening in the commodity space, because that in many ways powers the coffers of the Brazils, the other emerging markets that have started really participating in merger activity of late. Are we going to see that peter off if oil and some of the commodities don't stay as strong as they have been?
No, I don't think so at all. In fact, the emerging markets is the real fundamental driver in terms of the exceptional growth in the M&A market right now. If you look at where they were last year, it was 25% of the overall market, has moved to 35% of the overall global M&A market relates to the emerging markets. And it used to be that it was primarily for natural resources. That's where large industrialized nations and companies would go to get their natural resources or their manufacturing capacity. Today, people recognize that there's a fundamental shift in emerging markets. The population is increasing dramatically from a wealth point of view, and they're not a levered consumer. So you put those two together and you see real fundamental demand. Companies are moving into the emerging markets to get intellectual property, routes to market, end consumers, brands, so much more than natural resources and manufacturing capacity. So that's really where you're seeing the fundamental and probably secular shift in the emerging markets. It's 36% up over Q1 of last year.
So how much percentage-wise were emerging markets in M&A? What was it, like 10% of deals, or is it more?
35%.
Wow.
Globally, 35% of all transactions, up from 25% last year. So it's, most people don't realize it is a fundamental secular shift in the market. And
when it comes to the type of deals we're seeing, we've started to see one or two hostile bids get in there. Yep. Are we going to see more activity like that?
Well, 2009 to 2010 was a 42% increase in hostile transactions. Many of them, however, failed. And what most people find when they go hostile is if you're the acquirer, you don't necessarily get the target. It's also usually costing you more to go hostile than if you try to do a negotiated transaction. And a couple other things, rating agencies absolutely hate them, and so you're often subjecting yourself to a downgrade.
Why do they hate them?
Because it's not a friendly transaction, and it's disrupting to the bond community. So I think the fact is we still will see the trend, because fundamentally you have poison pills and staggered boards, other shareholder type defenses coming down. Companies are much more subject. If someone wants to go hostile, they are subject to that kind of activity. So we will see it, but the success rate will still be in question.